Hello. Today we're going to look at the statement of cash flows. We're going to learn what those numbers are and the rules that govern their classification and why we need the statement of cash flows. Whenever you show a balance sheet and an income statement, you must also present a statement of cash flows. Net income from the income statement can hide timing differences such as credit sales, meaning sales that we have not received cash for yet, or accrued expenses that we have not yet paid out. So the statement of cash flow presents a separate view of the actual cash movements, and we define cash to be cash plus cash equivalents and the restricted cash. So while a company can be profitable on paper, meaning from the income statement, it looks like it's profitable, we also need to see if they're going to have enough cash to last for the next quarter or next year and help us with our in assessing the company's future profitability, liquidity, and can they go long term with their cash that they have on hand. There are three categories of cash on the statement of cash flows, and those are operating activity, investing activity, and financing activity. There are two methods of reporting the operating activity section of the statement of cash flows. And we're going to go through each of them, but the direct method shows the cash effect of each operating activity, and it's reported as a cash inflow and cash outflow directly on the statement. And indirect starts with your net income and works backward to convert it to amount that is a cash basis. And we will take a look at that in a few slides. First, I just want to show you a sample of the indirect and direct method statement of cash flows. Please keep in mind that the direct and indirect method only affects the operating activity section of the statement of cash flow. The investing and financing activities remain the same. In the indirect method, we start with our net income from our income statement and we make adjustments, all the non-cash adjustments that are included in the net income, and we back them out or add them in, whatever, depending on which way it goes, to get to our true cash provided by the operating activity. Versus the direct method is, like the name states, is more direct in that it truly shows you all the cash inflows. So here we have our cash received from customers, meaning these are our cash sales, less our cash payments. And here's a cash payment to supplier for operating expenses, for taxes. And so you take your cash inflow, right, and minus your cash outflow, and you get your net cash provided by operating activities. I just want to note that whether you use a direct or indirect method for the operating activities, the end result will be the same. You should get the same net cash provided by operating activity no matter which method you choose. Let's talk about the operating activities in the statement of cash flows. And in the operating activity, we're gonna show the inflows and outflows of cash that result from activities reported in the income statement. And so what are examples of the cash inflows? Well, and so remember, these are all cash items. We're going to show our cash inflows are any sale of inventory or services, any interest income or dividend income we have from our investments, which is interesting because it does not go in the investing activities. So just keep that in mind. Maybe tax refunds we get, lawsuits that settled that we get. The cash outflow for operating activities would be a purchase of inventory, all of our G&A expenses, our general administrative like salaries, rent, utilities, and there's a lot more. Any interest expense that we pay on debt, income taxes that we pay, and lawsuits that we have to pay. those are all considered to be operating activities. So let's just take a look at how to get to our net cash from operating activity using the direct method and the indirect method. Before we can prepare a statement of cash flows, we need to have a comparative balance sheet, which means you have to have the current year and the prior year, plus the current year income statement for the period that you're preparing the statement of cash flow for. Let's just start with the direct method, which let's just go up, can't go up. So if you recall, the direct method shows the cash inflows less the cash outflows. In order to calculate the cash inflow and outflows for the direct method, what we have to do is we have to analyze the income statement, and we analyze the current asset section and current liability section of the balance sheet. Let's start with cash from customers. So how do we calculate how much revenue did we get in cash? So cash, when it's not from when we earn revenue that's not cash, we book it to accounts receivable. So we're going to analyze our accounts receivable account, and I'm going to draw a T account. And my starting accounts receivable balance is $33. Right here, that's my beginning from right here. And I know that my ending accounts receivable is $43, which just looking at this, I can say, well, yeah, my accounts receivable increased by $10. And how do we increase accounts receivable? Well, to increase accounts receivable, we debit accounts receivable and credit sales, right, or revenue. However, we see that our revenue is $100, but accounts receivable only went up $10. So let's just see what happened through the year. Well, we made sales of $100, which means we would book debit accounts receivable for $100, right? Bringing our accounts receivable subtotal to $133. But we ended up with $43. So that must mean that at some point during the year, we had to credit our accounts receivable by $90. Well, what does that mean? If we credited our accounts receivable by $90, what's the other side of that transaction? It would have had to be an inflow of cash. That's why we wrote off the accounts receivable. So that's how we calculate the cash received from sales for this direct method. We see that we had a cash inflow of $90. And let's go to right here. I will show you this for this Arlington Lawn Company. Our first line item is cash received from customers is $90. The next item we see on the statement of cash flow in the operating section is cash paid for general and administrative expense. And that's, you see how that's a minus because that's a cash outflow. Let's look to see how they calculate that $17. I'm going to go back to the previous, right here. I'm going to have to erase my drawings from the prior section just so I have space right here for everything. Kind of hard for me to see right here. Let's just, sorry, this is taking a while. Okay, so let's look at our G&A, back to our G&A right here, $32. We have to determine of this $32 expense, how much is it was a cash outflow. And what we're going to do is we're going to look at two accounts. Again, we're going to analyze our current assets and our current liabilities. We're going to look at our prepaid insurance, which would have been booked as insurance expense at some point and included in this $32. And we're going to look at accrued liabilities. Also, let's just call it whether it was a utility expense or salaries expense, also recording to this G&A expense of $32. It's all embedded in there. So let's look at prepaid insurance first. So you draw your prepaid insurance account. I'm just going to call it prepaid. And I see that I started with a balance of 5 and I ended up with a balance of 3. I know nothing else. It doesn't give me any more information, so I can just assume that we had credited prepaid at some point during the year for $2. So how would we have done that? We would have credited, like I said, prepaid, I'm going to call it prepaid, $2. And what would have been the debit? The debit would have been insurance expense for $2. So I know that for prepaid insurance, embedded in this $32 is $2 of an expense that did not go to cash. So now let's just take that 32 minus 2 because we know that that $2 was non-cash. So we're going to remove it from that number. Next, we're going to look at, and I'm going to erase this again because of space issues. Next, we're going to look at the accrued liabilities. It's hard for me to see this. The accrued liabilities account, right? So I'm going to draw my accrued liabilities, my T account for accrued liabilities. And we started with a $12 balance. Remember, this is a liability, so we start on the right side of the T account. And we ended up with a balance of 25, which means that we had to have credited accrued liabilities by $13, right? That's how we get that from $12 beginning balance to 25 ending balance. So again, how would I have recorded this $13? Well, I know that I credited accrued liabilities, $13. I'm just gonna. And what's my debit? My debit would have had to be some sort of expense, whether it's salaries expense, utilities expense, it doesn't matter. It was a debit, increasing my expense by 13. So we know that this increase in accrued liability hit an expense. There is no cash involved in that. And this expense, this $13, is also included in this 32. So we need to remove $13 of another $13 of non-cash expense, which leaves me with, I believe, $17 of G&A expense that now we know was all cash. So we're going to go back to the following page, and here we have cash paid for general and administrative expense, $17. That's how we get that number. Moving on, cash paid from income taxes. Let's go back up here and look at my eraser. Oops. I'm going to look next at my income tax payable because I have to look at all my current assets and current liabilities. So I've already, well, cash is cash, but I've looked at my AR and my prepaid and my accrued liabilities. So now I'm going to look at my income tax payable T account. I'm just going to draw it out here real quick. My beginning balance is $8. Remember, this is a liability, so on my T account goes on the right side, and it ended up with $5. And let's see what happened during the year. Well, I have income tax expense of $15. What would that entry have been? It would have been debit income tax expense, $15, credit income tax payable, $15. That's what would have happened to accrue my income tax payable, which leads me to a subtotal of 23. But my ending total is 5, right? So we know that sometime during the year, I would have credited income tax payable by $18. I had to do that math. So how do we credit income tax payable? We would do credit income tax payable $18. What would have been my debit? To reduce my payable means I paid out the, I'm sorry, I did this backwards. Sorry, I had to debit my income tax payable. I had to debit it here. So I had to debit my income tax payable for $18. And what would have caused me to reduce my taxes payable? I had to pay out my cash for $18. So therefore, I know that my cash payments for tax is $18. And let's go in here, and here's how I get my $18. That's how you calculate the direct method. Let's talk about the indirect method. And again, for the indirect method, you still need your comparative balance sheet and your income statement for the period. In the direct method, we're going to start with our income statement, our net income from our income statement, $45, which I'm going to go up here, is right here. And then what we're going to do is we're going to back out any adjustments that we know are non-cash. So we have depreciation expense on our income statement of $8. We know that's non-cash because to book depreciation expense, we would have debited depreciation expense, credited accumulated depreciation, no cash involved. To get to indirect, then we're going to look at also changes in our current assets and current liabilities. Let's just take a look at current accounts receivable, and then the rest of them will kind of follow. I'm not going to go through them one by one, but the increase, we're going to look at this is a bit easier than the direct method in that we're going to start with accounts receivable, and we just look at our changes in balance for the accounts receivable. And here we see we started with $33 at the beginning of the year, and we ended up with $43, which means we had an increase of $10 to accounts receivable. So for that $10, we're going to say of this $100 of sales revenue that we have, $10 of it is non-cash. So this $100 is already embedded in this $45, right? So we only have to account for the non-cash portion, and that's just $10. So we have to remove $10 of this because we know it's not cash from our starting income of $45. So if I go down, page down, right here to our indirect method, right here, you'll see my increase in accounts receivable is a reduction in net income. And that makes sense because the $100 of revenue is in here, and we already determined up here the $90 of it was cash received from customers, which means $10 of it is not cash received yet. So we're going to remove this $10. And then you go to your other current assets and current liabilities and calculate it to get to your net cash flow from operating activities of $55. Let's compare that to the direct method, which we did here, which also gives us net cash flow from operating activities for $55. So either way that you do it, you're gonna get to the same results. I encourage you to look at this. These slides are in the deck in the modules, to try to calculate the decrease in prepaid insurance and accrued liabilities and tax payable to see how they got to these numbers. But just follow the way I did the accounts receivable. Let's talk about the next section of the statement of cash flow, the investing activities section. And we're going to look at the inflows and outflows related to the acquisition and disposition or sale of long-term assets used in the operations of the business. So we're going to think of the long-term asset section of the balance sheet. That's what you're going to analyze to do the investing activities. And just keep in mind that the sale of inventory are not investing activities, they are operating activities. So some examples of the cash outflows is if we purchase items for investment. When we purchase a PP&E or intangible asset, that's considered investing activity. Or when we lend money to another entity or person, then we get notes receivable, we have a cash outflow, that's also investing activities. Cash inflows is when we sell our investment, we get cash for it, sell our PP&E or intangibles, or when we collect on that notes receivable, that would be considered cash outflows. Those are all examples of investing activities. Let's move on to financing activities, and those relate to a cash inflow and outflow of external financing with our owners or creditors. And it says excluding trade payables. Trade payables is accounts receivable. So that's part of our operating activities. And that's also a current asset. So we're not going to analyze current assets for financing activities. Cash inflows when we sell stock, right? Issuance of stock and we get cash, that's a financing activity. When we take out money from issuance of bonds or notes payable, meaning we owe others money to others and we get the cash for it, that's a cash inflow. When we pay dividends, that's a cash outflow. When we buy back our stock, that's called treasury stock. When we buy back stock, that's also a cash outflow. And when we repay our debts, that's a cash outflow. Just keep in mind, again, I said this earlier, the interest expense or interest income received from the bonds payable or bonds receivable or notes receivable is not a financing activity. The interest expense and interest income is actually an operating activity. So just that's something you just have to remember. And this is an example of investing and financing activity, part of the statement of cash flows. It is identical whether you have a direct method or indirect. So we are going to start with cash flow from investing activities, and we have a purchase of equipment. So that's an outflow. This is just a continuation of our operating section. If you look at net cash outflow from operating activities of $55, which we calculated both under the direct and indirect. And cash inflows from financing, we have issuance of common stock plus 10, dividends minus 5. And the way we're going to figure that out is we're going to go back up to right here. We're going to look at our income statement. I went back to our investing section. Let's take it. Purchase of equipment is minus $40. So when I go up to my balance sheet, my comparative balance sheet up here, and I look at my long-term asset, my equipment, it went from $120 to $60. And so that's an increase of $40, which means we purchased equipment and we laid out the cash for it. So that's why it's a reduction in cash for investing activity. If you look at your common stock increased plus 10. So that would be a credit to your common stock of 10 and a debit of cash. So we're going to have a plus 10 for a cash. To figure out our dividends paid, we have to look at our retained earnings. We started with 35. Don't forget that increases by 45 for your net income, right? Because our beginning retained earnings is 35 plus net income is 45. That gives us a subtotal of 80. But we ended up with 75 was our ending balance, which means we paid out dividends of 5. So you have to kind of back into all these numbers with your income statement and comparable balance sheet. But here's how we have an increase in cash from finance activity for common stock and a decrease for our dividends paid. Then we have a net cash flow from financing activity. And then we have our total net increase from cash. We take our operating activity 55, our decrease in investing of 40, and our increase in financing from 5 to give us to a net increase of $20. And what we do is we compare that to our cash balance on January 1st and cash balance at the end of the period, and that should be an increase of $20. If it's not, then there's something wrong with your statement of cash flows. So that's just a good check. Also reported in your statement of cash flow is any non-cash investing and financing activities. So, and it's just kind of almost like a footnote in the statement. You say let's just say we acquired equipment, which is an investing activity, by issuing a long-term note payable, which is a financing activity. So you just have to report it. You report in the face of the statement of cash flow or in a disclosure note. This slide is just a summary of kind of what we've gone over, and it's also in the deck. I just want to point out one quick thing for the cash flow. I just want to remind you that when we collect interest, I think I said this before, or pay interest, that goes in the operating activity. But also when we collect dividends from stock that we own, of other companies, that's considered a operating cash flow. When we pay dividends on our own stock, that's considered financing cash flow. So just want to remind you and point that out.